Somewhere in America right now, a family is making a decision. They have two options. Pay the hospital bill, which is $14,000, or pay the rent. They cannot do both. And here is the part no one tells you. They have insurance. They paid every single premium, every single month, for 6 years. They did everything right. And they still have to choose between a hospital and a home. That is not a glitch in the American insurance system. That is the American insurance system working exactly as designed. So today we are going to break it apart. Not to make you angry. Not to make you hopeless. But because understanding how this machine actually runs changes how you interact with it. And that knowledge, right now, in this economy, is worth more than most financial advice you will ever receive. Let us start at the beginning. Insurance is, in its purest form, a bet. You pay a company a small amount of money every month. The company bets you will not need expensive care. You bet that you might. If you never get sick, they win. If you do get sick, they pay. That is the whole model. The industry calls it risk pooling. You spread the risk across millions of people so no single person gets destroyed by a catastrophic event. A beautiful idea. Genuinely elegant in theory. But here is where the theory starts to quietly fall apart. The companies that sell you this protection are not charities. They are publicly traded corporations with shareholders, earnings calls, and quarterly growth targets. Their job, legally and structurally, is not to pay your claims. Their job is to generate returns. And that tension, between what insurance promises and what it is built to do, is the core tension of everything that follows. Now there are 6 main types of insurance in the United States that almost every American will encounter at some point in their life. Health, life, auto, homeowners or renters, disability, and liability. Each one operates on the same basic model but with wildly different rules, wildly different fine print, and wildly different ways to deny you. Let us walk through what each one actually is before we get to the part where the math gets uncomfortable. Health insurance is the most complex and the most personal. You pay a monthly premium just to be covered. But being covered does not mean your care is free. You also have a deductible, which is the amount you must spend out of pocket before insurance kicks in at all. In 2024, the average deductible for an individual on a workplace plan was over $1,500. For families, over $3,000. Then you have co-pays, which are flat fees per visit. Coinsurance, which is your percentage share of the bill after the deductible. And an out-of-pocket maximum, which sounds reassuring until you realize it can legally be as high as $9,000 for an individual. So in a bad year, a fully insured American can still owe $9,000 in medical costs on top of their premiums. And they are the lucky ones. 60% of personal bankruptcies in the United States are linked to medical debt. Most of those people had insurance. Life insurance is simpler but stranger. You pay while you are alive so that when you die, your family receives a sum of money. Term life covers you for a fixed number of years. Whole life covers you indefinitely and builds something called cash value, which is where the sales pitches begin and the complexity multiplies. Auto insurance is legally mandatory in 49 of 50 states. You must have it to drive. Which means the industry has a captive market of over 200 million licensed drivers. And yet premium rates have increased faster than inflation every single year since 2020. We will come back to why. Homeowners insurance covers your structure against fire, theft, flood, and disaster. Except flood. Flood is almost always a separate policy. And increasingly, wildfire is being excluded too. Climate is rewriting the fine print in real time. Renters insurance is the most underused product in America. 60% of renters have none. It costs about $15 a month. It covers everything inside your apartment if it burns down or gets stolen. Most people simply do not know it exists. And disability insurance, the one nobody talks about, covers your income if you become too sick or injured to work. 1 in 4 Americans will experience a disability before they retire. The average long-term disability claim lasts nearly 3 years. And most Americans have zero coverage. That is the landscape. 6 systems. Hundreds of millions of people inside them. And a set of rules that almost nobody reads until the moment they desperately need to understand them. Which brings us to part 2. Where the numbers start telling a different story than the brochure.
Here is a number that should stop you cold. The American insurance industry collects approximately $2.8 trillion in premiums every single year. 2.8 trillion. That is larger than the GDP of France. It is more than the United States spends on Medicare and Medicaid combined. And it flows, quietly, systematically, from the wallets of ordinary people into one of the most profitable industries in the history of capitalism. Now none of that is secret. It is all in the public filings. The strange part is how few people think about what it means. Here is what it means. Every dollar you pay in premiums is going into a pool. From that pool, the insurance company pays claims. It pays administrative costs. It pays salaries. It pays lobbying. And whatever is left over, that is profit. The industry term for how well they manage this is the loss ratio. It is the percentage of premium dollars that actually get paid back out in claims. A loss ratio of 80% means for every dollar you pay, 80 cents goes to claims and 20 cents goes to the company. The Affordable Care Act actually mandated a minimum loss ratio of 80% for individual plans and 85% for large group plans. Before that law, some insurers were paying back as little as 60 cents on the dollar. The other 40 went to overhead, marketing, executive compensation, and shareholder returns. Even at 80%, the math is stark. On a $1,200 annual premium, $240 is kept by the company regardless of your health. Multiply that across 40 million policyholders and you understand how this industry works without anyone technically doing anything illegal. Now here is where it gets more sophisticated and more troubling. Insurance companies do not just hold your premiums in a vault. They invest them. The money you pay in January earns interest, dividends, and capital gains before the company ever has to pay a single claim. This is called the float, and Warren Buffett has described it as one of the greatest business models ever invented. He should know. Berkshire Hathaway owns several large insurance companies. The float means that even in years when claims are high, the investment income can still produce enormous profits. The insurance company is essentially borrowing your money at zero interest, investing it, and keeping the gains. You are the lender. You just never signed up to be. Now let us talk about denial. Insurance companies denied approximately 17% of in-network claims in 2023 according to federal data. 17%. That is not a small number. That is 1 in 6 claims, sent by your doctor, for care your doctor believes you need, being rejected. The appeals process exists. Most people do not use it. Of those who do appeal, roughly 40% win their case. Which means the original denial was wrong. 40% of the time. And the industry knows that most people will not fight. Because fighting takes time and energy and expertise that sick people often do not have. This is not cynical speculation. This is the documented business logic. Fewer paid claims means higher profit margins. The system is calibrated accordingly. And here is the final uncomfortable layer. The United States spends more on healthcare per person than any other nation on Earth. More than Canada. More than Germany. More than Japan. More than any country with universal coverage. And yet American health outcomes, life expectancy, infant mortality, chronic disease rates, rank below most of those same countries. The insurance layer does not improve care. It adds cost, complexity, and a layer of financial gatekeeping between you and a doctor. Every other wealthy nation has concluded this. America has not. So you are left with a question that nobody in Washington seems particularly eager to answer. If the system costs more, delivers less, denies claims at scale, and leaves millions uninsured or underinsured, what exactly is it optimized for? The answer, if you follow the money honestly, is not your health. And knowing that, really knowing it, is where any serious conversation about your finances has to begin. Because the largest financial risk most Americans face is not a bad stock pick or a missed mortgage payment. It is the moment the system they paid into for years quietly decides that this particular claim, for this particular reason, on this particular technicality, does not qualify. And you are left